I'm Shay Russell from mining.com.au, and once again, it is that time of week where Mr. Data Dan tears himself away from the spreadsheets and comes and shares what he's found with us. Hello, Data Dan. Welcome back.
Hello, Shay. How are you?
I'm
I've
excellent.
got
How
two
are
sets of
you?
glasses today because that's how much data I've been assessing. So there we are.
That is proof that you are a freak for the sheets. Speaking of, all right, let's kick off today. So, our last conversation 2 weeks ago, we were talking about how we were sort of interested in lending because the housing data came out, and you pointed out in one of our former conversations that there is a lot of money heading into housing. But what you wanted to know was, what is business lending look like? Mr. Data Dan, what do the charts reveal?
Well, the charts reveal that in terms of that major commercial acquisition of property and even alterations, it's actually it's on the decline at the moment, and so there's been a little bit of a bump up, and whether that's a byproduct of um, a byproduct of higher interest rates remains to be seen. But just so if we look at the chart here, Shay, we're currently at 5 billion for the quarter. So previously that's been 6.49, then 6 billion, and then it was 5. So uh, to give you an example, back in 2021, those numbers were 7.7, 8.8, 10.9, 7.4 billion dollars worth of those fixed term large businesses purchasing new property for plant and equipment. So that's a really big takeout from that. So I'll just put even my refined glasses on to simply say that on that one there, that if we were to look at new construction, now this is new commitment, it's less than a billion, so it's 700 million. That's across the country. So we're seeing a
Oh.
rather sharp kind of almost moderation. That's really hasn't done much in the last 3 years. Now, we've spoken a lot about it, but there it is borne out in the data. The fact of the matter, at the moment, it's $5 billion, and normally it hovers around between 7 and 8. So that's been quite the takeout of that data at the moment. So where are we seeing it? Well, there's obviously construction industries, mining services, resources are big drivers of it, but obviously capital works on behalf of government is the only game in town. So infrastructure plays in the East Coast cities, sure, but in terms of that, plant investment, equipment hire, everything like that, that's definitely moderating.
Interesting. Well, what I wouldn't mind now moving from that, because I think this is going to tell a very similar story, but just looking at a different sector, is we did touch on last time we spoke about insolvencies. And I made the joke that it feels like a cafe's going under every week here in Melbourne, as well as retail shops. But the chart really shows who the clear winner of insolvencies is. Data Dan, reveal all.
Well, I'll tell you one thing, you're not far wrong with your cafes going under. So just to give you the indication there, so during COVID, when you had like some kind of the government went down this path of having kind of almost a Chapter 11 style protection where you could trade your way out, providing you had enough capital, enough cash flow to meet some of those commitments, and they were normally around employee obligations and things like that. So back in 2021-22, they had that, and so in accommodation and food services, for example, there was 191, 196. So the run rate around 200 per quarter nationally. We're going into some sort of insolvencies. In the last quarter, in the June quarter, we've just had 635. 700 in accommodation, 870. That's one, two, three. So those numbers are now what in December, March. So the last 3 quarters are all 600 plus, and that's where they're importing insolvency, creditors for the first time. People to oversee those wind downs. Some, admittedly, are orderly. So when we talk about an orderly way of exiting a business, it can be actually where they just collapse the thing. But generally speaking, in those sectors where really the case of their services, they're low margin, high cost, they're definitely coming in for attention. Now, construction is the number one. So June, September, December, March, the most recent June we've had now, are all above 1,000 uh, per quarter. So in other words, that construction is more. These are companies and businesses which are basically appointing administration. Now you'll often hear the term phoenixing, where they kind of which enables particularly in construction again, another one which is low margin, high labor cost. If the projects don't stack up, the other problem is when you're building something on a blank canvas, so to speak. It can be when you do the pricing for it. The moment you say, "Well, we'll do a fixed price," and then you get halfway through it and you go, "Heck, we're on top of an archaeological site or whatever. There's water mains which we didn't account for." Building in the variations can be very tough, and so that often does not
Mm.
augur well for construction. So they've got the high risk, high cost, low margin businesses. And again, they've been into September 2021 in the quarter. There's 335 construction businesses nationally were appointing
Yeah,
receivers. That number in June 2025 was 1,010.
that is huge and
Mm.
concerning.
Yeah, so and just in resources, so obviously that's the beat we're in, so to speak. Now that number, mining is surprisingly, it was 61, 58, 92, 82. So like it was actually higher last year, but again, still toppy. No, back in 2021, it was 44, 65, 27. Mining, of course, and resources generally is all to do with the vagaries of you either run out of cash if you can't advance the exploration model, or the commodity price gets you. So that's what we saw with particularly a lot of those lithium and battery metals exposed when the price fell out of that. That was definitely a problem. So really interesting data here, Shay, because we get to see this, like where it's all going on within the economy. But retail, of course, as you'd expect, problematic. Then there's warehousing, not so manufacturing, toppy, uh, that's in the above 200s, but it's also reflected the fact that manufacturing as an employer now is at the ninth or 10th largest employer in Australia. And so the manufacturers we see now are ones
Mm.
where you have manufacturers which either they import the part and they assemble it here, or it's a smaller, low cost, high end, uh, specialized area of manufacturing, which tends to be where the growth is, not so much in the kind of the widgets we get from Asia, so to speak.
These are particularly interesting. Stacking up the business lending by industry compared to the insolvencies by industry, it would be definitely worth us checking back in on this in another quarter from now, simply to see if things have topped out and bottom out, so to speak of each chart, or if they've gotten progressively worse in that time.
Well, I think there's definitely so we're seeing now that there's definitely problems ahead. Like I mean, one of the things that the government now has is that we've got the tariff stuff coming through. Well, growth is now kind of moderating, so it's kind of this wait and see. So it's you really can start to assess that if the next quarter's data drops and we see that number again high, that represents a year that so there's definitely a trend starting to emerge there, which is obviously what tends to drive what we talk about, Shay. But it is very concerning the fact of the matter Australia's currency's on the up. So in other words, you do have a few things where you become a little bit less competitive, not too much, because most things are done in US dollars, but yeah, there is definitely a trend which is problematic for government especially.
Super interesting, and you can bet your bottom dollar I will mark a date in the calendar and come back and annoy you about that data. But just before I let you go today, as we jumped on today's call, the recent round of trade data was dropping. Now, obviously, it's too soon for you to have gone through it, so I will hold you to a couple of charts for next week. But did you notice anything? Did anything sort of stand out as we went to take today's call?
Well, there's a couple of things I'm just looking at. I've just got some of the commodity data coming through. So trade, as we saw, just so we've got it here, that in the May it was again a surplus, 1.4 billion. What's been very interesting, iron ore, the value of iron ore exports has jumped from 9.6 to 10.4 billion. Scrap metals again, 141 million. Nickel kind of thereabouts. Copper is elevated, so 800 million. That was copper ore concentrates. Shay, our favorite at the moment, aluminum. How's this?
Yes.
1.1 billion dollars. So that's again maintaining the rage, if you'd like. So that's the 13th consecutive month of $1 billion in aluminium ore concentrate sales. Now those ores, of course, go to the likes of the Middle East, Asia, India. So they're not really focused on the American market. So that's quite telling to see that again. If I just do the calculation, they're $15.234 billion in aluminum sales in the last year alone. So that's like a
That's
30% jump.
very, very interesting, especially just it's a timely reminder that the tariffs probably aren't going to impact our aluminum exports as much as the media would have us think.
No, but the good news is for those of you who like traditional coal sales, they were at 5 billion for the month, so $73 billion for the 12 months to June. So that's again a very good story. So sometimes the headline, like where we think about you know these kind of big numbers, they can often mask some of the problems which we were talking about just before at the domestic level. But if you're a treasury, if you're a nervous treasurer, let's say that you're Jim Chalmers, you would be quietly delighted with these trade figures in terms of what the commodities are still holding up.
But I have no doubt our politicians will take credit for it as well. Listen, Mr. Data Dan, I know you were on a tight timeline today, and no doubt to get back to that trade data. Listen, thank you so much for today. I'm going to hold you to some of those charts next week, and I look forward to next week's conversation.
See you then.